If I had to pick one of the most common questions that we get in investing in a pre-construction fourplex, it has to do with the construction loan. People always want to know about that, what it's going to be like. Can I go get my own, right? There's a lot of questions that revolve around that. First, I want to talk about, can you go get your own or not? I hate to give such a wishy-washy answer, but maybe, kind of, probably. Is that specific enough? The challenge is we're talking about a construction loan on a multifamily asset. And it's not just any bank that is going to be willing to do that. We've usually found that it's small community, local, regional banks and credit unions that are willing to issue construction loans on multifamily property. Now, here's the challenge. Anytime you do that, and I've kind of explained this in past videos, we're dealing with attached units here. So we might have, let's say, 8 townhouses in a row that's platted as 2 fourplexes, right? There's a big advantage in having the same construction lender on those because you can't begin construction on Unit A unless you know Unit B has already closed or will be closing soon. So guess what happens when you bring in another lender off the street that nobody knows, we haven't vetted, we're not sure if they can actually close or not. You get in a bad position where Unit A has closed, can't start construction because Unit B has a lender that's just not working out. So we're watching for that constantly as there's specific banks that we have paired into these projects. And that makes people always ask and always wonder, well, am I getting ripped off? Am I paying too much money for my construction loan? And sometimes at a quick glance on the terms of a construction loan, they might think that because they're inadvertently comparing it to a 30-year fixed rate loan. It's not the same thing. Construction loans usually have rates of, they'll say, prime plus 1, right? Whatever the prime rate is, plus a percentage, maybe prime plus 1.5, is the interest rate on a construction loan. It's not the same as the Quicken Loan guy on TV or whatever rate you heard from a loan broker most recently. Right now, as I record this, they're like around 5 to 5.5%. That's prime plus 1 right now. And the biggest component is they're interest only. And they're typically for a set period of time, usually a year, right? When we talk about a loan amortizing, that means every payment you make, you're paying down the principal. You don't do that on a construction loan. It's just straight interest only for a year. And when that year is up, you've got to pay the construction loan off. And most of our investors do that with a refinance into a 30-year fixed rate mortgage. Another big question is, well, are they expensive? Well, they are what they are. You got to remember it's a highly specialized product. It's not something you can call up Wells Fargo or whoever and say, will you do this? So you're looking, like I said, at origination of a percent or so. And then a big key is when you close on your construction loan, that's when you make your down payment. You're 25% down. That's when you do that. And you're also going to prepay interest reserves. The lender doesn't want to have to track you down for a check every month for what you've drawn out of the construction loan. They just put those interest reserves when you close in an account. And every month, as the builder draws against your construction loan, the corresponding amount of interest is debited from that account. Usually what I see is when somebody closes on a fourplex, they've got about $34,000 in, we call it buying costs. Title fees, attorney fees, appraisal, HOA setup, right? All the typical closing costs that you're used to in a normal transaction. But $34,000 sounds pretty thick. That's because it's got that interest for a full year baked into the cake. So what you'll see on a construction loan is during the 12-month contract to build your fourplex, you get like 7 or 8 different draw requests. These come over as a DocuSign from the construction team at FIG. It's going to say, please sign this draw request for $50,000. It's for your permit, your foundation, your footings, your underground plumbing, whatever, right? And you're going to sign that. Now, most importantly, what happens once you sign that, the construction team doesn't just get the money. The bank doesn't want to pay any draws out for loans and deals that have not been constructed. So they're going to send an inspector out to the job site to confirm that, yes, permit, foundation, footing, plumbing, right? That kind of stuff is done. And when the inspector independently confirms that, yes, those things have been done, then and only then is the builder paid for that portion of the fourplex budget. And so what happens is at the end of the month, your construction loan balance that was previously $0 is now $50,000. And they're going to take that interest rate of, let's say, 5%, multiply by 50,000, divide by 12, and that amount is what gets debited from your interest reserve for the month. So you can see at the beginning of the construction process, your interest payments are very small. But then as we progress, as the builder draws down more on that construction loan, those payments get bigger. But the construction lenders know that. They calculate them so that they're not having to beg you for more money at the end, or you're not having to, put more money in. Nobody wants that. So it's streamlined so that there's an adequate interest reserve there. And then when you're done, you refi out of it, you're into a long-term 30-year fixed rate where the savings are. That's where you're usually going to see a rate that's lower than wherever construction loans are at the time. So bottom line is construction loans, they're for a year, they're interest only. The rate is a little bit higher than what you'll see on a 30-year fixed, but that's normal because all banks do construction loans typically on a prime plus a set percentage. So we get the question a lot too, like, is it easier to get a construction loan than a 30-year fixed? Not really. I think that you generally have to be a little bit better qualified to get a construction loan. However, if you've got adequate credit and you've got the down payment funds, if you qualify for one, you qualify for the other. Ironically, the way you qualify for construction loans on a FIG deal, for example, is you get pre-qualified with our preferred long-term lender, Lane Aldrich, who's going to do some videos with us on that too. He's going to do the typical mortgage approval with you that you may have been through. I need your tax returns, bank statements, W-2s, right? Any other things for them to get a good picture of you as a borrower. And then they're going to take that pre-qualification to one of the construction lenders we use in the market where the properties are. And that lender approves you for the construction loan based on that, right? Because they know, hey, if we give a construction loan, so-and-so is good to pay it off because Lane approved him for a 30-year fixed rate loan. Whatever one you get, construction or long-term, they're going to want pretty much the same stuff. Tax returns, W-2s, right? A financial statement. But just know they have a bunch of questions, and that's the world that we live in. But if you got decent FICO score, you got the down payment, right? There's nothing crazy going on. You're probably going to qualify, but we need to get you with the lender to determine that for sure. I frequently get asked, well, what happens if the builder takes too long on my fourplex or my duplex? Now let's first quantify, what does too long actually mean, right? When you sign a purchase agreement on a FIG deal, that is a 12-month purchase contract, unless the contract says otherwise, but I can't think of a time where it's never not been 12 months. That's about what it takes to put one of these things together front and back. In a perfect world, you could build a fourplex in 6 months, but construction, especially in 2021, is not perfect. You need time for uncertainties and curveballs that come up. So 12 months is the contractual time frame. So what happens is people get concerned, well, I've got this construction loan. They budgeted for 12 months worth of interest. What if it takes too long, right? Well, we want the builder team to be incentivized to complete these on time. So if the builder takes longer than 12 months to get you your final certificate of occupancy, that's, finish line, then they're going to owe you a penalty of $500 a door per month. That's what happens, because guess what? The construction lender doesn't care if you say, well, FIG said it was going to be that. You have a note with the construction lender that you've got to pay. So what happens is the investor they have to pay a little extra interest to the construction lender, but then they've got $500 a door per month coming back to them. I always get asked, is that enough to cover all of it? I don't know. It's close. Sometimes it's a little more, sometimes it's a little less, but generally the builder is going to go over 30, maybe 60 days tops in most cases. And that doesn't happen very often. They usually deliver within the 12 months. So that's a good way to think about, well, what if the builder takes too long? There's a penalty. They're heavily incentivized to make sure they don't take too long. Now, even more rare is, what if the builder takes shorter than 12 months? It could happen. If you have some money left in your interest reserve account, by the time you do your refinance, then that money is going to be coming back to you, right? But as you know, in the world of construction, things usually take a little longer, not a little shorter in most cases. So hopefully that helps. I get asked if we've changed our construction loan process and over the time that FIG has been in business. And yeah, definitely we have. It used to be that we'd cover whatever costs you have above and beyond the 12 months, right? Instead of a set amount. And that gets to be crazy because you can get into a big dispute about what costs you actually have versus what you should have, right? So we don't really have control over what end financing an investor goes and does. And so, hey, I have this cost. Well, we don't know what you did. So we have that flat penalty that happens every single month over the 12 months on a construction loan. That's one change that has been made. Another that has been made is now we declare units done when they have a certificate of occupancy when they're actually done. What we've learned is a city will give a certificate of occupancy. It's kind of shocking what they'll give one on. They'll show up to a property and they'll walk through it and say, yeah, a human can live here. That's what a certificate of occupancy means. But outside, there could be rebar sticking out of the ground, mud everywhere, chunks of concrete. It's not ready for tenants. And that's what you're counting on. That's what matters to you as an investor. So there's a difference between certificate of occupancy and rent ready. And sometimes we're guilty of using those terms interchangeably. So if you're talking to one of us, make sure you say, hey, are you talking like certificate of occupancy by the book or like full on rent ready tenants can move in? That's something that's really important to distinguish.